Dipan Mehta, good morning. Thank you for joining us. So Dipan, was it half marathon? Was it full marathon? Half marathon, what was the score? Full marathon, if you managed, man, hats off to you.
Good morning, Nikunj, and thank you for remembering that marathons are a special day for me, especially the Tata Mumbai
Marathon
Marathon.
pictures on DP, everybody will see it, my friend.
No, it was a half marathon and it was a very good race. I finished quite strong, so that was the most pleasing part. And I would urge everyone in that at least they should do one marathon in their life. It is a completely life-changing experience. So all I can
Saying
say
that we are
that
doing SIPs, we are happy with that financial marathon. Real marathon is tough. SIP is the real marathon for us.
absolutely, absolutely.
Okay, so
So
what was your score? Under 2 hours? More than 2 hours?
no, 2 hours, 36 minutes, under 2 hours is absolutely, I cannot even do it in my dreams now. So that's like going at 6 kilometers per hour, which is really quite phenomenal.
अरे हो जाएगा दिपिन भाई यहाँ पहुंचे हो तो 10 minutes every year 6 years you will be able to achieve it. No worry about that. Okay, market. The sprint is over for a lot of stocks.
That's right, Nikunj. I think that we are having challenges in the stock market at this point of time. And many reasons have been offered, like geopolitical event, FII selling, many other small and minor reasons, US markets. But it is my clear-cut understanding that we are in for a slightly longish and deepish correction because corporate results have been disappointing. I mean, so far, whatever numbers we have seen, they've been okay, but they've not been phenomenal. And when you look at the way the banks have come with numbers, mid cap and large cap software, FMCG company like Hindustan Unilever, large company like Reliance Industries, a few NBFCs as well, the results are good. They're in that 10-12% type of growth rates, but nothing which will encourage you or induce you to buy more shares of the same company, especially given the valuations that these companies are trading at. A lot of the profit margin expansion has come through commodity prices, and that also will level off. And we are seeing minor compression of margin in a few select industries as well. So it's not that it's everything is just phenomenal and we are in kind of blue sky scenario as far as corporate earnings are concerned. And that's going to be the pain point for the next 6 months. I think this earnings season, next earnings season could be very disappointing. And whenever you have a earnings season, you do a reality check what the trailing 12-month earnings per share is and what the price to earnings multiple is. And you will find that the risk return reward doesn't favor you to make fresh bets at these levels.
Okay. Dipan Mehta, I look at banks and I look at all the banks, at least the banks which have come out with numbers. Growth is okay, but there is sliver of a concern in terms of NPS coming back. And I'm talking about private banks here. Banks, in fact, are also slowing down because they are not getting a great liability franchise. So for a sector which was supposed to make a comeback, the first flush of numbers has not been encouraging for them.
Yeah, absolutely. I think that gradually compression of net interest margins is creeping in. Banks themselves have become a bit more cautious in lending, which is reflected in slightly slower growth in advances. There's a war for deposits happening over there, and they don't want to increase the interest rates. This it affect their NIMs even further. And on the whole, I think it was fee-based income, trading profits, which drove the bank earnings this quarter. But the core pre-provisioning operating profits were not that great, so one needs to keep that in mind. And this could last for 2-3 quarters or so as well. The bankers have made representation to the RBI to kind of infuse more liquidity into the system. We'll see how that plays out. But by and large, I think bank earnings may be muted for a couple of more quarters. But then valuations also have come off significantly, and they are trading at reasonable valuations. And if you're bullish on long term in India in terms of growth and economy, then you can't be bearish on banks per se for a longer period of time. But next 2-3 quarters could be challenging.
So you're not cutting on your banking exposure, you're still sticking to it.
Yeah, well, I think in a way the corrections have taken place and the traded and the price to earnings, price to book at which these banks are trading at, and considering that over a longer period of time, private sector banks will gain market share and they will, get their rhythm back. I'm not selling any of the banks, but certainly not buying also at these levels.
Just wanted to understand whether right now you would say that if you've been profit taking the last 10 odd days or so, keep the powder dry, or would you say start nibbling in wherever you find value already?
No, no, no. I'm not nibbling anywhere. I'm just waiting patiently. Wherever numbers are not up to expectations, trim a few holdings over there. And I seriously expect that this correction could be as deep as 10-12% on the Nifty and the Sensex. Who knows, we may even test the 200-day moving average, which I think is around 19,000 or so, at least at some point during the year. So keeping all of that in mind, I want to be a bit cautious. We haven't yet got into the earnings season as far as mid-cap stocks are concerned, especially the favorite ones like the PSU defense stocks or the railway stocks. Let's see how those numbers pan out. And then, I would make a more informed call. But by and large, whatever I see so far from the earnings, it's been quite disappointing, maybe except for a Cipla or a Ultratech Cement, which came with good set of numbers. I don't think any company really so far has impressed us that this was something which was not expected and the numbers are beyond what the street was expecting.
Uh, Bank Nifty 45,000. So Dipan suddenly does not feel like a bull market, right?
No, Nikunj, it is a bull market. In a bull market, you can always have a 10-12% correction, and that will flush out all the weak players. It will remove a little bit of the euphoria and reset expectations. You cannot have stocks of companies growing at 10-12%, trading at 45-50 price to earnings multiple. So, some of those correction has to take place over there. Part of it could be time-wise correction, where earnings keep on moving up 10, 12, 15%, but stock price remains static or slightly lower. And we have to have some kind of a cooling off period before the next leg of the bull market starts. I think this leg of the bull market, we've already created a top, and we should see a fairly steep correction. And thereafter, I think, once stocks are moved to stronger hands, we can see the bull market starting again. This is, make no mistake, I'm very bullish on India. It is a multi-year bull market. It's not that I'm going 70-80% into cash. It's just that I'm being a bit cautious. I've seen such bull markets where there could be steep corrections, and if you end up buying at the top, then you do not have any strategic cash left when there is a correction to buy into good quality stocks at reasonable valuations. The problem just now is that good quality businesses are trading at very high price to earnings multiple, and if you buy them at these levels, you cannot expect to have a decent return on the investments which you have made.
Dipan Mehta, was this a concern yesterday, or markets are trying to simply find a reason for yesterday's fall?
No, yesterday's fall was because of Z. It really dampened the sentiment over there. And also, I think there was nothing really on a positive trigger in terms of earnings per se. And overall, I think, FI selling was visible on the screen, which is why we saw this kind of a sell-off. And one really cannot attribute any reason why such sell-offs take place, but you know very well that when a selling pressure comes, the fall in the market is much faster than the rise. And panic always moves markets far more quickly than greed. So that's what has happened over there. And I think a lot of trading positions got unbound. Brokers would have called up their clients to reduce their positions as well, because margins may have also been triggered. And on the whole, I think the overall leverage positions also would have come under pressure. So that, I think, is what has taken place, and we may see more of this in the coming weeks as well.
Pre-open rates 68 points higher for Nifty. It is looking. Look, there's no storm in the world. That's good news. What happened because of Z, like Dipan pointed out, that look, margin funding, stock, margin funding, or perhaps the fact that there was margin funding against the Z stock, that could have led to a market in terms of a domino effect. Look, markets are at such level that any technical as change in the short term, whether it is big or small, could have a domino effect. I mean, this is not a market which exactly could be called as feather light. FNO positions, your margin funding positions, which I think happens in every market, but those are factors which tend to have a very exaggerated impact in the market. I mean, remember the law of, remember one simple line, which is that you always go up the staircase, but you drop like a stone from the top of a hill. So the fall will always be large, fall will always be magnified, the fall will always shake you. The bull market has not got uprooted, folks. Please don't cancel your subs. But if luck made you money in 2023, Dipan Mehta. Our tagline this year is that risk and skill will help you make money in 2024. Would you agree with that? That it was luck in 2023, it will be skill and risk management this year.
Nikunj, you put it really very well. I think 22, 23 and for latter half of 22 were great years for individual investors. They saw their portfolios really outperform the Sensex and Nifty. 40-50% type of returns were generated. That's not expected to be repeated in 2024. It's going to be very tricky, very stock specific, very selective. Your research skills also will be tested, which stocks, which sectors you are in. And this is going to be a big, I would say, important year for testing the conviction of investors, whether in mutual funds through SIPs or in direct equity. It's going to test your conviction, I think, this 2024 year. And that's going to be really the defining moments in this year. And I would be extremely cautious. And as I said, that, it's good to be a bit liquid at this point of time. I am seeing that demand is slightly softening across sectors. Base effect, and mind is a very important point, base effect is having a big impact on corporate earnings. And that's going to be visible right through this earnings season and the next as well. So, and it's perfectly fine. I think, if you want to look at, if you want to make money in the bull markets, you have to traverse and, kind of manage the bearish phases within these bull markets as well. So I think everybody will be tested this year.
Okay, let's get you some mid-cap. Dipan Mehta, thank you for joining us. Really appreciate your time. And next year, Dipan Mehta, 2 hour 36 minutes, maybe 2 hour 20 minutes.
Oh, well, we can always hope that much better. Thank you.
Thank you very much.